Hello and welcome. If you're a small business owner in the United States, you know that you wear many hats. You're the CEO, the head of marketing, the customer service representative, and often the bookkeeper. It's a rewarding journey, but it can also be overwhelming, especially when it comes to one of the most complex and critical aspects of your business: taxes. How to find a reputable tax expert for your U.S. small business is designed to be your guide. Over the next several chapters, we will walk you through the entire process of finding, vetting, and building a successful relationship with a tax professional who can become one of your greatest assets. But before we dive into the how, we need to firmly establish the why. This first chapter is all about building the foundation. We'll explore why engaging a tax expert isn't just an expense to be managed during tax season, but a strategic investment in the health, stability, and long-term growth of your business. Important disclaimer. Please remember, the information provided in this series is for educational and informational purposes only. It is not intended to be, and should not be taken as financial, legal, or tax advice. The United States tax code is incredibly complex and varies based on your specific circumstances, business structure, and location. You should always consult with a qualified and licensed professional for advice tailored to your individual situation. Our goal here is to empower you to find that professional. So let's begin by dismantling a common misconception. Many new entrepreneurs view a tax professional as someone you call in a panic during the first 2 weeks of April. You hand them a shoebox of receipts, they work some magic, and you get a number to pay or a refund to receive. While they certainly do that, limiting their role to just filing your annual return is like using a powerful smartphone only to make phone calls. You're missing out on 90% of its value. The true value of a reputable tax expert lies in proactive, year-round strategy. A great tax professional is a planner, not just a preparer. They help you build a tax-efficient framework for your business from the ground up. This involves crucial decisions that you, as a business owner, have to make long before tax day ever arrives. For example, consider your business structure. Are you a sole proprietor? An LLC? Have you considered an S-corp election? Each of these structures has profound and dramatically different tax implications. Making the right choice early on can save you thousands, or even tens of thousands, of dollars each year. Making the wrong choice can lead to overpaying in taxes and creating unnecessary complications. A tax expert can analyze your specific business model, your income levels, and your growth projections to help you understand the pros and cons of each option, enabling you to make an informed decision. This strategic partnership extends to your day-to-day operations. How are you managing your bookkeeping? Are your books set up in a way that accurately captures all your income and, just as importantly, all of your legitimate expenses? A tax expert can advise on the best bookkeeping practices and software for your industry. They ensure that from January 1st to December 31st, your financial data is clean, organized, and ready for tax planning. This simple act of getting your bookkeeping right not only makes tax filing smoother, but also gives you a clearer picture of your business's financial health at any given moment. Now let's talk about the cost of going it alone. The do-it-yourself approach, often fueled by seemingly user-friendly software, can be tempting, but it carries significant, often hidden risks. The first major risk is missing out on deductions and credits. The U.S. tax code is a labyrinth of rules, and within it are hundreds of potential deductions and credits specifically designed for businesses. While you might know about the big ones, like office supplies, a true expert knows the nuances. They understand industry-specific deductions that you might never have heard of. They can guide you on the proper way to deduct vehicle expenses, the home office deduction, or the depreciation of major equipment. Missing just a few of these year after year can add up to a substantial amount of money left on the table. Money that could have been reinvested into your business. The second, and perhaps more intimidating, risk is compliance. The tax code isn't just about saving money, it's about following the law. Making mistakes can be costly. An incorrect filing could trigger an audit from the IRS, a stressful and time-consuming process that pulls you away from running your business. Penalties and interest for underpayment can be severe. A reputable tax expert acts as your first line of defense. They ensure your returns are accurate, complete, and filed correctly, significantly reducing your risk of facing an audit. They understand the difference between tax avoidance, which is the legal minimization of your tax liability, and tax evasion, which is illegal. That peace of mind alone is invaluable. Finally, consider the value of your own time. As a business owner, your time is your most precious resource. How many hours would you spend researching tax laws, deciphering IRS forms, and organizing receipts? 10 hours. 20? 50? Now, what is that time worth? What if you could spend those hours developing a new product, meeting with potential clients, or improving your marketing strategy? The opportunity cost of doing your own taxes is immense. Delegating this complex task to a professional allows you to focus on what you do best: growing your business. Ultimately, you should view a tax expert not as a cost center, but as a strategic partner who can generate a significant return on your investment. They save you money by optimizing your tax position. They save you time by handling the complex compliance work. And they provide you with the peace of mind that comes from knowing your financial house is in order. They can act as a sounding board for major financial decisions, like whether to lease or buy equipment, how to structure compensation for a new employee, or the tax implications of expanding into a new state. So, to recap this foundational chapter, a reputable tax expert is far more than just a tax preparer. They are a year-round strategic advisor who helps you with business structure, proactive tax planning, and compliance. Attempting to handle this complex domain yourself can lead to missed savings, increased audit risk, and a critical loss of your own valuable time. Now that you understand why you need an expert, our next step is to understand the different players on the field. In Chapter 2, we will break down the different types of tax professionals, from CPAs and enrolled agents to tax attorneys, and explore which one is the right fit for your small business's unique needs. Thank you for listening. Welcome back to How to Find a Reputable Tax Expert for Your U.S. Small Business. In our last chapter, we established the crucial why, exploring the immense value a tax professional brings to your business as a year-round strategic partner. We discussed how they save you time, reduce your risk, and help you keep more of your hard-earned money through proactive planning. Now that you understand why this partnership is so vital, it's time to move on to the who. When you begin your search, you'll quickly encounter a world of different titles and acronyms: CPA, enrolled agent, tax attorney, and more. It can be confusing. What's the difference? And more importantly, which one is right for your business? In this chapter, we're going to demystify these credentials. We will break down the primary types of tax professionals, what their qualifications mean, and the typical services they provide. Think of this as learning about the players on the field before you decide who to draft for your team. A quick reminder: this information is for educational purposes only, and is not an endorsement or recommendation of any specific type of professional. The best choice for your business depends entirely on your unique circumstances, complexity, and specific needs. Our goal is to give you the knowledge to evaluate these professionals effectively. Let's start with one of the most widely recognized credentials: the Certified Public Accountant, or CPA. A CPA is a state-licensed accounting professional. The path to becoming a CPA is rigorous and standardized across the country, which is why the credential is so respected. It typically requires extensive education, usually 150 college credit hours, passing a very difficult 4-part national examination, and meeting strict state-level experience and ethics requirements. Because of this comprehensive training, a CPA's expertise is broad. While they are highly skilled in tax preparation and planning, their knowledge base extends across the entire landscape of business finance. They can also perform audits and reviews of financial statements, provide business consulting services, assist with financial planning, and help manage accounting systems. So, who might a CPA be a good fit for? A CPA is often an excellent choice for a small business that is looking for a holistic financial advisor. If you anticipate needing services beyond just tax preparation, like needing audited financial statements to secure a bank loan or attract investors, or if you want strategic advice on cash flow management, budgeting, and long-term business planning, a CPA is equipped to provide that comprehensive support. They can look at the big picture of your business's financial health, with taxes being one important piece of that puzzle. Next, let's discuss a credential that is laser-focused on taxation: the enrolled agent, or EA. An enrolled agent is a tax specialist who is federally licensed directly by the Department of the Treasury. This is a key difference from CPAs, who are licensed by state boards. The EA credential signifies a profound expertise specifically in the U.S. tax code. To become an EA, a person must either pass a comprehensive 3-part examination administered by the IRS that covers all aspects of taxation, or they must have gained sufficient experience working for the IRS in a qualifying position. The most significant power of an enrolled agent is their unlimited right to practice before the IRS. This means they can represent any taxpayer, be it an individual, a corporation, or a partnership, on any tax matter, including audits, collections, and appeals. An enrolled agent is often a fantastic choice for a business whose primary need is expert-level tax compliance and strategy. If your business has complex tax situations, operates in multiple states, or if you're simply looking for the deepest possible knowledge of the tax code to ensure you're minimizing your liability legally, an EA is a dedicated specialist. If your main concern is, I want to make sure my taxes are done perfectly, and I have a strong advocate if the IRS ever comes knocking, an enrolled agent is trained and licensed specifically for that role. Think of a CPA as a great general doctor for your business's finances, while an EA is the leading specialist in the complex field of taxation. Now let's talk about a third type of professional, who you'll typically engage for more specific, high-stakes situations: the tax attorney. A tax attorney is first and foremost a lawyer. They have earned a Juris Doctor (JD) degree, passed a state bar exam, and specialize in tax law. Many even have an advanced law degree and Master of Laws in taxation, making them experts in the legal interpretation of the tax code. You generally wouldn't hire a tax attorney for routine annual tax preparation, though some do offer that service. Their role is typically focused on the legal aspects of tax. This includes representing clients in disputes with the IRS that end up in U.S. tax court, handling criminal tax investigations, and structuring complex business transactions like mergers and acquisitions from a legal and tax perspective. They are also invaluable for sophisticated estate planning. A critical advantage they offer is attorney-client privilege, which provides a level of legal protection for your communications that is generally stronger than the confidentiality offered by CPAs or EAs. For most small businesses with standard operational needs, a tax attorney may be more specialized than necessary. However, if you find yourself in a serious legal dispute with tax authorities or are navigating a very complex business deal, their expertise is indispensable. Finally, it's worth mentioning unlicensed preparers. Many individuals prepare tax returns without holding a CPA or EA license. To do so legally for compensation, they must obtain a Preparer Tax Identification Number, or PTIN, from the IRS. Some may also complete the IRS's voluntary annual filing season program to gain a bit more training. However, their rights to represent clients before the IRS are extremely limited. For a growing small business, relying on a preparer without a professional credential can be risky, as they may lack the depth of knowledge and the authority to represent you if a problem arises. To summarize, you have three main types of credentialed experts to consider: CPAs, who are state-licensed, broad-based financial strategists; enrolled agents, who are federally licensed, deep tax specialists; and tax attorneys, who are legal experts for complex tax disputes and transactions. The right choice depends on your needs. Do you need a holistic financial guide, a pure tax specialist, or a legal advocate? Understanding these roles is the first, most critical step in your journey. Now that you know who the players are, how do you go about finding them? In Chapter 3, we'll dive into the practical steps and explore the most effective places to search for qualified candidates, from professional directories to the power of personal referrals. Thank you for listening. Welcome back to How to Find a Reputable Tax Expert for Your U.S. Small Business. In our first chapter, we established why you need an expert. In Chapter 2, we clarified who the key players are: the CPAs, the enrolled agents, and the tax attorneys. You now understand their unique credentials and the specialized value they each bring to the table. With that foundational knowledge in place, we arrive at the next logical question: where do you actually find these professionals? It's one thing to know you need a CPA or an EA. It's another to find a specific, reputable person you can trust with your business's sensitive financial information. In this chapter, we will outline the most effective and reliable strategies for building a list of potential candidates. We'll cover everything from official professional directories to the power of your personal network. Think of this as drawing the map that will lead you to the right people. As always, a brief reminder: the purpose of this chapter is to guide your search process. We are providing resources and strategies for informational purposes only. We do not endorse any specific individual, firm, or directory. The ultimate responsibility to research, vet, and choose the right professional for your unique business situation rests entirely with you. Let's begin with what many consider the gold standard for starting a search: professional organization directories. The major advantage of using these directories is that they are maintained by the very organizations that license and govern these professionals. This means that anyone you find listed here has already met a verified standard of education, examination, and ethical conduct. It's a fantastic way to ensure you're starting with a pool of truly qualified individuals. For certified public accountants (CPAs), a primary resource is the American Institute of Certified Public Accountants, or AICPA. They offer resources for the public to find member CPAs. Even more targeted, every state has its own society of CPAs, and their websites are often the best place to find a licensed professional in your specific area. You can often filter your search by location and by specialty, such as small business taxation. For enrolled agents (EAs), the go-to resource is the National Association of Enrolled Agents, or NEA. Since EAs are federally licensed, the NEA directory is a comprehensive, nationwide database. There, Find a Tax Expert tool allows you to search for EAs in your zip code, who can provide the specialized tax expertise and IRS representation we discussed in the last chapter. For tax attorneys, you can turn to the American Bar Association, ABA, or your specific state's bar association. These organizations have member directories that can typically be searched by legal specialty. Look for attorneys who list tax law as their primary area of practice. Using these official directories is a safe, reliable first step to generate an initial list of 3 to 5 potential candidates in your area. Our second strategy leverages your most valuable asset, your network. Let's talk about the power of personal and professional referrals. A recommendation from someone you trust can be incredibly valuable. It provides a level of insight that a simple online search cannot. However, the key is to ask the right people. Start with other small business owners, especially those in your industry or a similar one. Their business structure and tax challenges may mirror your own. Ask them who they use, what their experience has been like, and what they particularly like about their tax professional. Another excellent source for referrals is your other trusted advisors. Your business banker or your business attorney, for instance, works with tax professionals constantly. They see the results of both good and bad tax planning, and can often point you toward experts with a strong reputation in the business community. A word of caution on referrals. A great recommendation is a starting point, not a final decision. The tax expert who is a perfect fit for your friend's construction company may not be the best choice for your online marketing agency. Every business is unique. Use referrals to add names to your list, but be prepared to conduct your own independent evaluation to ensure they are the right fit for your specific needs. We'll cover how to do that in our next chapter. Finally, let's explore some powerful digital and official government resources. The most direct and authoritative tool available is the IRS Directory of Federal Tax Return Preparers with credentials and select qualifications. This is a free, searchable database on the IRS website. You can use it to find preparers in your area and, crucially, to verify their credentials. It includes CPAs, enrolled agents, attorneys, and other preparers. Using this directory gives you absolute confidence that the person you're researching is in good standing with the IRS. Of course, you can also use targeted online searches. Using specific keywords in a search engine like Small Business CPA in Atlanta or Tax Planner for e-commerce can yield good results. Professional networking platforms like LinkedIn are also useful. You can search for tax professionals, review their career history, see their areas of focus, and look for recommendations from their clients. Don't forget to look locally. Your local Chamber of Commerce or a Small Business Development Center, SBDC, is dedicated to supporting the local business ecosystem. They often have lists of member professionals, or can provide recommendations based on their community network. To summarize this chapter, your search for a tax expert should be a multi-pronged approach. First, consult official professional directories from organizations like the AICPA and NEA to find credential-verified candidates. Second, leverage your network by asking other business owners and trusted advisors for referrals. And third, use powerful tools like the official IRS directory and targeted online searches to round out your list. Your goal at the end of this stage should be to have a list of 3 to 5 promising candidates. Once you have your list of names, the real work of evaluation begins. How do you go from a name on a list to a trusted partner? In Chapter 4, we will cover the critical next step, conducting the initial consultation. We'll give you the key questions you must ask to properly vet your candidates and find the perfect fit for your business. Thank you for listening. Welcome back to How to Find a Reputable Tax Expert for Your U.S. Small Business. In our journey so far, we've covered the essential groundwork. We established why a tax expert is a critical partner, we defined who the different types of professionals are, and in our last chapter, we detailed where to find a list of qualified candidates. If you followed along, you should now have a short list of 3 to 5 promising names. This is where the process moves from research to interaction. You are now ready for the single most important step in making your decision. The initial consultation or interview. The goal of this meeting is not to get free tax advice. Instead, it is a crucial opportunity to evaluate a professional's expertise, their communication style, and their overall suitability as a long-term partner for your business. In this chapter, we will provide a playbook of key questions to ask. These questions are organized into categories to help you systematically assess each candidate. A necessary reminder: the information and questions provided here are for educational purposes, designed to help you conduct a thorough evaluation. This is not tax advice, and the correct answers will vary based on your specific business needs. Your objective is to gather information to make your own informed decision. Let's begin with the first and most critical category of questions, which focuses on experience and specialization. Your goal here is to determine if the professional has the right kind of experience for your specific business. The first question you should ask is, can you describe your experience working with small businesses, specifically those in my industry? This question is vital. The tax code has nuances that can be highly industry-specific. A professional who works primarily with restaurants will understand the unique rules around tips and inventory, which is very different from an expert who specializes in software-as-a-service companies and their rules around revenue recognition. Listen for specific examples, not just a generic, "Yes, we work with small businesses." Next, follow up with, what percentage of your practice is dedicated to small business clients versus individual tax returns? There's nothing wrong with a professional who serves both, but this question helps you understand their primary focus. A firm that dedicates a significant portion of its resources to businesses like yours is more likely to be attuned to your needs and proactive about business-related tax law changes. Finally, in this category, ask, how do you stay current with the frequent changes in federal and state tax laws? The tax code is not static. It changes every year. A competent professional must be committed to continuous learning. A good answer will involve things like attending professional seminars, subscribing to tax law journals, and being a member of professional organizations. This question reveals their dedication to their craft. Once you have a sense of their expertise, you need to understand how they work with their clients. Our second category of questions is about communication and client management. A technically brilliant expert can still be a poor fit if your communication styles don't align. Start with a simple, practical question. If I become a client, who will be my primary point of contact? In a larger firm, the partner you meet with may not be the person handling your day-to-day questions. You might be assigned to a junior associate. There's nothing inherently wrong with this model, but it's essential to know upfront who you will be communicating with regularly. Next, clarify expectations by asking, what is your preferred method for communication, and what is your typical response time for client inquiries? Do they prefer email, phone calls, or a secure online portal? Will you get a response within 24 hours, 48 hours, or longer? This question prevents future frustration by setting clear expectations for how and when you will communicate. Perhaps most importantly, ask, how proactive are you with tax planning throughout the year? This question separates a strategic advisor from a simple tax preparer. A reactive preparer waits for you to give them documents in March. A proactive advisor will contact you in the fall to discuss year-end strategies, ask about major purchases, and help you project your tax liability, so there are no surprises in April. Their answer here reveals their philosophy on client service. Our final category of questions is one that many people feel hesitant to ask, but it is absolutely essential: fees and billing. You must have a crystal clear understanding of how you will be charged to avoid misunderstandings down the road. Begin with a direct question. Could you please explain your fee structure? Do you charge a flat fee for tax preparation, or do you bill by the hour? Neither is inherently better, but they suit different needs. A flat fee provides predictability, while hourly billing might be more cost-effective if your needs are simple. Ask them to explain why they use their chosen model. Follow up with this crucial clarifying question. What specific services are included in that fee, and what would be considered an extra charge? For example, is a 15-minute phone call in August to discuss a new equipment purchase included in your annual fee, or will you receive a separate bill for it? Is responding to a simple IRS notice included? Getting a detailed list of what's included versus what's a la carte is key to understanding the full cost of the engagement. To wrap up this conversation, you can ask, do you charge for this initial consultation? Most professionals offer a brief, complimentary initial meeting, but it's always professional and wise to confirm this beforehand. By the end of the interview, you should have a clear picture of the professional's expertise, their process, and their pricing. You're looking for someone who not only has the right technical skills, but also communicates clearly and operates their business in a way that makes you feel comfortable and confident. Now that you've conducted your interviews, how do you process all this information and make the final choice? In Chapter 5, we will walk you through evaluating the answers you received, the importance of checking references, and how to confidently select the right tax expert for your small business. Thank you for listening. Welcome back to How to Find a Reputable Tax Expert for Your U.S. Small Business. You have come a long way in this journey. You understand why this role is critical. You know who the different professionals are. You've learned where to find them, and you have successfully conducted interviews using the key questions from our last chapter. At this point, you likely have a collection of notes, quotes, and first impressions from your conversations with several qualified candidates. The final piece of the puzzle is to synthesize all of this information into a single, confident decision. This chapter is your guide to that final evaluation process. We will cover how to thoughtfully compare your candidates, perform the last crucial steps of due diligence, and properly formalize your new professional relationship. As we proceed, please keep in mind, this chapter provides a framework for your decision-making process. It is for educational purposes only. The right choice is subjective and depends entirely on your business's unique needs and your personal comfort level with the professional. Our goal is to empower you to make that choice with clarity and confidence. Let's begin with the first step, the post-interview debrief and evaluation. It's best to do this within a day or two of your final interview. While the conversations are still fresh in your mind, take out your notes and instead of just looking at the answers, think about the substance behind them. Let's break this evaluation into 3 key areas. First, expertise and industry fit. Go beyond a simple yes or no on whether they have experience in your industry. Which candidate gave you the most specific, confident, and insightful answers about businesses like yours? Did they mention challenges or opportunities you hadn't even considered? The goal is to find someone who doesn't just understand the general tax code, but understands how it specifically applies to your world. A generic approach is not what you're looking for. Second, consider communication and rapport. This is a long-term relationship, so professional chemistry matters. Who did you feel most comfortable with? Who explained complex tax concepts in a way that was clear and easy to understand, without making you feel intimidated? Did one person seem more like a patient teacher, while another seemed like a busy lecturer? Think about your own personality. If you are someone who asks a lot of questions, you'll want a professional who is patient and approachable. Their communication style should align with your own. Third, analyze the value proposition, not just the price. It's natural to compare the fee structures you were quoted, but resist the temptation to simply choose the cheapest option. The lowest price can sometimes be the most expensive in the long run if it means missed deductions or poor advice. Instead, ask yourself, what value am I getting for this fee? The candidate with a higher flat fee who offers proactive, year-round tax planning might provide far more value and save you more money than the cheaper, hourly professional who only engages with you once a year. After you've debriefed and have a leading candidate or two in mind, it's time for the non-negotiable step of final due diligence. This is where you verify their credentials and, if possible, check references. First, verify their professional license. This is a simple but critical check that confirms they are in good standing with their governing body. For a CPA, you can typically go to your state's Board of Accountancy website and search for their name or license number. This will show if their license is active and if there have been any public disciplinary actions against them. For an enrolled agent, you can use the IRS Directory of Federal Tax Return Preparers that we mentioned in Chapter 3 to confirm their status. For a tax attorney, you can check their standing on your state's Bar Association website. This process usually only takes a few minutes online and provides essential peace of mind. Next, check references. You should feel comfortable asking your top candidate for 1 or 2 references from other small business clients. When you speak with these references, you can ask targeted questions like, how would you describe their communication style throughout the year? Have they been proactive in bringing new tax-saving ideas to your attention? And is their billing process clear and consistent with what you originally agreed upon? This gives you a real-world perspective on what it's like to work with them. Once your due diligence is complete, you are ready to make the final decision. By now, you've combined your logical evaluation of their skills with your gut feeling about who you can trust. Make the call, inform them of your decision, and express your excitement to begin working together. But you're not quite done.
Disclaimer: this video is for informational and educational purposes only and should not be considered professional legal, financial, or tax advice. I am not a certified public accountant, CPA, or a tax attorney. You should consult with a qualified professional for advice tailored to your individual situation. Tax laws are complex and subject to change. The creator of this video or the channel will not be held liable for any actions taken based on the information provided.
The final step is to formalize the relationship with an engagement letter. An engagement letter is a formal contract between you and your new tax professional. It is an incredibly important document. It outlines the scope of the services to be provided, the fee structure, the timeline for deliverables, and the responsibilities of both you and the professional. This letter protects both parties by setting clear expectations from the very beginning. Read it carefully. Make sure it accurately reflects everything you discussed and agreed upon. It should clearly state what services are included for the quoted fee, and what would constitute extra work at an additional charge. This letter is a legally binding document. If you have any questions or concerns about its terms, it may be wise to have a legal professional review it before you sign. To recap, your final selection process involves evaluating the interviews based on expertise, communication, and value. Performing due diligence by verifying credentials and checking references, making a clear decision, and formalizing it with a detailed engagement letter. Congratulations! By completing this process, you have done more than just hire a tax preparer. You have established a professional partnership that can safeguard and enhance the financial health of your business for years to come. Now that you have your expert, how do you build a successful and productive working relationship? In Chapter 6, we will discuss the best practices for working effectively with your new tax advisor, including how to prepare for meetings and how to maximize the value of your new partnership all year long. Thank you for listening. Welcome back to How to Find a Reputable Tax Expert for Your U.S. Small Business. If you've been following our chapters in order, let me be the first to say congratulations. You have navigated the complex process of finding, vetting, and finally selecting a qualified professional to be on your team. This is a significant milestone for any small business owner, and a major step towards building a strong financial foundation. However, the work doesn't stop the moment you sign the engagement letter. You haven't just delegated a task, you have entered into a professional partnership. And like any successful partnership, it requires active participation, clear communication, and mutual respect from both sides. The value you get out of this relationship is directly related to the effort you put into it. In this chapter, we will shift our focus to your role in this new partnership. We'll discuss the best practices for working effectively with your tax advisor to ensure the relationship is productive, efficient, and provides maximum value for your business throughout the year. As always, a reminder: the best practices discussed here are for informational and educational purposes. They are designed to help you manage a professional relationship effectively. This content is not, and should not be considered, financial, accounting, or tax advice. Let's start with the absolute foundation of a good working relationship: your role in organization and record keeping. Your tax professional's advice, analysis, and work are only as good as the information you provide them. Think of it this way: you wouldn't expect a doctor to give an accurate diagnosis without good information. The same is true for the financial health of your business. The shoebox full of crumpled receipts is the enemy of effective tax planning. Your first and most impactful habit should be to maintain clean, current, and accurate financial records. The best way to do this is to embrace digital bookkeeping. Using a dedicated accounting software is no longer a luxury for small businesses, it's a necessity. It allows you to track income and expenses in real time, generate financial reports with a few clicks, and give your tax expert a clear and accurate picture of your business at any given moment. A critical part of good record keeping is to strictly separate your business and personal finances. This is one of the most common mistakes new entrepreneurs make. Open a dedicated business bank account and use a business credit card for all business-related expenses. Commingling funds by paying for groceries with your business debit card or buying inventory with your personal credit card creates a messy, complicated financial trail. It makes your tax professional's job significantly harder and can even put you at risk if your business is ever audited. Finally, be consistent. Set aside a specific time each week or month to update your books, categorize transactions, and reconcile your accounts. This small, consistent effort prevents the overwhelming year-end scramble and allows your tax expert to perform proactive analysis, rather than just historical cleanup. Now for what is arguably the golden rule of a successful client-advisor relationship: communicate proactively. Do not wait until tax season to talk to your expert. The most valuable tax advice is given before a financial decision is made, not after. You need to train yourself to see your tax professional as a strategic advisor to consult with during the year. Here is a list of common business events that should immediately trigger a call or an email to your tax expert. You are planning to hire your first employee. The tax implications are very different from using an independent contractor. You are considering a large asset purchase, such as a company vehicle, expensive machinery, or real estate. You are planning to expand your business operations into another state. You are thinking about changing your business's legal structure, for instance, from an LLC to an S corporation. You are about to take on a significant business loan or bring in outside investors. You are making any substantial, unusual change in how your business operates. By looping in your expert beforehand, you allow them to provide insight on the tax consequences and help you structure the decision in the most tax-advantaged way possible. It's infinitely easier and cheaper to plan correctly than to fix a mistake later. Next, let's talk about making your meetings matter. Both your time and your expert's time are valuable. Being prepared for your scheduled meetings ensures that you use that time as efficiently as possible. Before any meeting, prepare and send a simple agenda. This can be a short, bulleted list of the key topics and questions you want to discuss. This allows your professional to review your file and prepare thoughtful answers, rather than being put on the spot. It transforms the meeting from a simple update into a productive working session. Also, have your documents ready. If you want to discuss your recent sales trends, have your profit and loss statement available. If you're asking about a specific transaction, have the relevant invoice or bank statement on hand. And it's always a good practice to briefly review your own key financial reports before you meet, so you can ask specific and informed questions. To summarize, being a great client boils down to a few key habits. Stay organized. Keep your financial records clean, separate, and up to date. Communicate proactively. Inform your expert before you make major financial moves. Be prepared. Respect your mutual time by preparing for meetings. This is a collaborative partnership. By providing clean data and proactive communication, you empower your expert to deliver the strategic insights that will truly benefit your business. As your business grows and evolves, its needs will change. How do you ensure this partnership continues to be the right fit in the years to come? In Chapter 7, we'll discuss how to conduct an annual review of your tax professional relationship and what signs might indicate it's time to seek a different kind of expertise. Thank you for listening. Welcome back to How to Find a Reputable Tax Expert for Your U.S. Small Business. In our last chapter, we discussed the best practices for building a strong, collaborative partnership with your new tax advisor. You learned that being an organized, proactive client is the key to unlocking the most value from their expertise. But a partnership, like any other critical component of your business, be it a software subscription or a key supplier, shouldn't be set on autopilot forever. Businesses evolve. Professionals evolve. To ensure that this vital relationship continues to serve your best interests, it's essential to conduct a regular, objective review. In this chapter, we will discuss how to perform a healthy and productive annual checkup on your relationship with your tax professional. We'll cover the positive signs of a thriving partnership to look for, as well as some potential red flags that might indicate it's time to have a deeper conversation or even reevaluate your needs. Let's begin with our standard reminder. This chapter offers a framework for evaluating a professional service relationship for educational purposes. It is not financial or legal advice. The decision to continue or change a professional is a significant one that rests solely with you, the business owner, based on your own judgment and circumstances. First, let's establish why an annual review is a smart business practice. Performing a yearly review of your tax professional is not a sign of distrust. On the contrary, it's a sign of good business governance. You review your marketing strategy, your budget, and your operational efficiency. This key partnership deserves the same level of strategic attention. There are two main reasons for this. First, your business is constantly changing. In the beginning, your needs might have been simple, but as you grow, your complexity grows with you. You might hire more employees, start offering new products or services, expand into new states, or even begin selling internationally. Each of these steps introduces new tax considerations. The expert who was perfect for your startup phase may not have the specific expertise required for your growth phase. Second, your tax professional's practice can also change. A key partner you worked with might retire. The firm might be acquired by a larger entity with a different service model. They might decide to shift their focus to a different industry or to larger clients. An annual check-in ensures that their services and focus are still aligned with your needs. Now let's start with the positive. What are the green flags? The signs of a healthy, thriving partnership. Knowing what good looks like provides a benchmark against which you can measure your own experience. The first green flag is proactive communication. A great tax partner doesn't just wait for you to call them. They reach out to you. Do they contact you in the third or fourth quarter to schedule a year-end tax planning session? Do they send you alerts or newsletters about significant tax law changes that could affect your business? This proactivity is the hallmark of a true advisor, not just a preparer. The second green flag is an educational approach. When you ask a question, do they give you a brief, technical answer? Or do they take the time to explain the why behind it in terms you can understand? A valuable expert empowers you by helping you become a more knowledgeable business owner. They should make you feel more confident in your financial decisions, not more confused. Third is responsiveness and reliability. This is fundamental. When you reach out with a question, do they respond within the time frame you agreed upon? Do they meet filing deadlines and other commitments without you having to constantly follow up? A reliable professional brings peace of mind. An unreliable one adds stress. Finally, a key green flag is a demonstrated interest in your business goals. Does your expert ask about your plans for the upcoming year? Do they inquire about your growth targets, your hiring plans, or your major investment goals? When they understand where you're going, they can provide advice that helps you get there. They see themselves as part of your journey. Now let's discuss the other side of the coin. What are some potential red flags? The signs it might be time to reevaluate. It's important to view these not as automatic reasons to end a relationship, but as indicators that a serious conversation is needed. The first and most common red flag is a chronic lack of communication. If your emails and phone calls consistently go unanswered for long periods, or if you feel like you are always the one initiating contact, it's a problem. Your business's financial questions are time-sensitive, and you need an advisor who is accessible. Another serious red flag is a pattern of errors or a lack of attention to detail. Everyone makes mistakes, but if you're repeatedly finding errors in your tax returns, financial reports, or other documents prepared by them, it undermines the trust that is essential for this relationship. Consider whether their approach is purely reactive. If the only time you hear from your tax professional is during the 2 months leading up to the tax deadline, you are likely not getting the strategic planning value you need. Your business operates for 12 months a year, and your tax strategy should too. A very common and often no-fault red flag is when your business has outgrown their expertise. Perhaps you've expanded into e-commerce, and they have little experience with sales tax nexus. Or maybe you're starting to explore international markets, and they specialize only in domestic tax. Recognizing that your needs have surpassed their capabilities is a natural part of business growth. To summarize, conducting an annual objective review of this key relationship is a vital part of responsible business management. Celebrate the green flags, and don't ignore the red flags. If you do notice issues, the professional first step is to schedule a meeting to discuss your concerns directly. But what if, after that conversation, you determine that a change is truly necessary? How do you handle that transition? In Chapter 8, we will provide a step-by-step guide to switching tax professionals smoothly and professionally, without creating disruption for your business. Thank you for listening. Welcome back to How to Find a Reputable Tax Expert for Your U.S. Small Business. In our last chapter, we discussed the importance of conducting an annual review of your relationship with your tax professional. We explored the positive green flags of a healthy partnership and the potential red flags that might signal a need to reevaluate. Making the decision to change a key advisor is never easy, but for a growing business, it can be a necessary and strategic step. Once you've made that decision, the immediate question becomes, now what? How do you handle the transition in a way that is professional, ethical, and most importantly, doesn't create disruption or risk for your business? In this chapter, we will provide a clear, step-by-step guide to navigating this process. Our goal is to demystify the transition and give you a professional playbook to ensure a smooth and seamless handoff from one expert to the next. As we begin, please remember, this guide outlines procedural best practices based on common professional standards. It is for informational purposes only and does not constitute legal or contractual advice. Your specific obligations may be detailed in your engagement letter, which you should always review carefully. Let's start with the single most important rule of this entire process. Step 1. Secure your new advisor before ending your current relationship. This may sound counterintuitive, but it is absolutely critical. You should never terminate your relationship with your current professional until you have formally hired their replacement. Leaving your business without representation, even for a short time, can be risky. What if you have an urgent question, receive a notice from the IRS, or a deadline is approaching? By hiring your new expert first, you ensure there is no gap in coverage. Your new advisor will have their own specific onboarding process and can provide valuable guidance on how to manage the transition and what specific documents they will need from your previous firm. This puts you in a position of control and ensures a seamless handoff rather than leaving you in a vulnerable transitional phase. Once your new expert is officially on board, it's time for a bit of groundwork. Step 2. Review your engagement letter and settle your accounts. Before you make any communication, locate the original engagement letter you signed with your current tax professional. This is your contract. Read it carefully, paying close attention to any clauses related to the termination of services. It might specify a required notice period or outline the process for final billing. Understanding these terms will help you manage the process according to the agreement you both signed. At the same time, ensure your account with the firm is paid in full. Settling any outstanding invoices before you announce your departure is a crucial act of professionalism. It ensures the relationship ends on a positive financial note, and often leads to a more cooperative and timely transfer of your records. Now for the step that many business owners feel the most anxiety about. Step 3. Professionally notify your current expert. The key here is to be professional, direct, and brief. This communication does not need to be a dramatic, face-to-face confrontation. In most cases, a well-written email is the most appropriate and effective method. Your notification should include 4 key elements. First, be clear and direct. State your decision plainly, for example. This email is to inform you that we will be transitioning our tax and accounting services to a new provider, effective date. Second, be brief and professional. You are not obligated to provide a long, detailed list of your reasons for leaving. Doing so can often lead to an unproductive and uncomfortable exchange. A simple neutral statement like, "We have decided to make a change that we feel is a better fit for the new direction of our business," is perfectly sufficient. Third, be appreciative. Unless the circumstances were extremely negative, it is always good practice to thank them for their services to date. A simple, "Thank you for the work you have done for us," helps keep the tone professional and respectful. Finally, be forward-looking. Let them know what to expect next. For example, "Our new advisor will be in contact with you shortly to coordinate the secure transfer of our files." By keeping the communication professional and to the point, you make the process less about emotion and more about procedure. This leads directly to the next phase. Step 4. Facilitate the transfer of documents. Your new professional will need access to your history. This includes, at a minimum, copies of your tax returns for the past 3 to 5 years, detailed depreciation schedules, and any other relevant financial statements or legal documents. This is a standard professional practice, and tax preparers are ethically bound to return a client's records. Your new advisor will typically handle this directly by sending a formal request to the previous firm. Your primary role in this step is to provide a written authorization, usually via email, to your former expert, giving them permission to release your information to your new representative. This ensures the process adheres to privacy and confidentiality rules. Be prepared to follow up politely to ensure the transfer happens in a timely manner. By following these professional and orderly steps, hiring first, reviewing your contract, notifying respectfully, and facilitating the document transfer, you can turn a potentially stressful decision into a straightforward business process. Now that your new partnership is in place, it's time to look forward. To be an effective partner to your advisor, you need to understand the rhythm of the business tax year. In Chapter 9, we'll explore the key tax deadlines and milestones every U.S. small business owner needs to have on their calendar. Thank you for listening. Welcome back to How to Find a Reputable Tax Expert for Your U.S. Small Business. In our last several chapters, we've focused on the human side of the equation, finding, vetting, and building a strong working relationship with your tax advisor. You are now equipped with the knowledge to manage that partnership effectively. Now let's turn our attention to the timeline that governs your business's financial life, the tax calendar. Staying compliant with tax law is not just a once-a-year event. It is a year-round responsibility with a rhythm of specific deadlines and milestones. Understanding this calendar is essential for avoiding costly penalties and managing your cash flow effectively. In this chapter, we will provide a high-level overview of the most common federal tax deadlines that small business owners in the United States need to be aware of. Critical disclaimer: this chapter is for informational and educational purposes only. The information provided is a general guide for businesses operating on a standard December 31st calendar year. Tax deadlines can and do vary significantly based on your specific business structure, such as an S-corp versus a C-corp, your state and local tax authorities, and whether you operate on a fiscal year instead of a calendar year. This overview is designed to make you aware of the landscape, not to serve as your specific filing schedule. You must consult with your qualified tax professional to confirm the exact deadlines that apply to your unique business situation. Let's start with the most frequent and important rhythm of the tax year: the quarterly cadence of estimated tax payments. The U.S. tax system is a pay-as-you-go system. This means that as a business owner, you are generally required to pay taxes on your income as you earn it throughout the year, not just in one lump sum in April. These payments are called estimated taxes, and they cover both your income tax and your self-employment taxes, which are Social Security and Medicare taxes. For a typical calendar year business, there are 4 key due dates for federal estimated tax payments. The first payment is due on April 15th, covering income you earned from January 1st through March 31st. The second is due on June 15th, for income earned from April 1st through May 31st. The third is due on September 15th, for income earned from June 1st through August 31st. And the final payment for the year is due on January 15th of the next year, covering income from September 1st through December 31st. Notice that the periods are not all 3 months long. This is one of the many complexities of the system. Calculating the correct amount to pay for each of these deadlines is a crucial task that your tax professional will help you with, often by analyzing your year-to-date profit and loss statements. Next, let's talk about the rush of activity that happens right at the beginning of a new year, which relates to the year that just ended. This is the period for information reporting. A major deadline for all businesses with employees, or that use independent contractors, is January 31st. By this date, you are required to prepare and send out several key forms. For your employees, you must provide them with their Form W-2, which details their total wages and tax withholdings for the previous year. For any independent contractor or business you paid $600 or more to during the year for services, you must provide them with Form 1099 NEC, which stands for Non-Employee Compensation. It's critical to understand that this deadline isn't just for sending the forms to the recipients. You also have to file copies of these forms with the government, the Social Security Administration for W-2s, and the IRS for 1099s, by this same date. Meeting this January 31st deadline is a fundamental compliance task. After the information reporting is done, we move into the main event: the spring filing season for annual business tax returns. A common misconception is that all tax returns are due on the same day. This is not true for businesses. The deadline for your main annual income tax return depends on your business's legal structure. The first major deadline is March 15th. This is the due date for businesses structured as S-corporations, who file Form 1120-S, and partnerships, who file Form 1065. These are known as pass-through entities, meaning the profit or loss is passed through to the owner's personal tax returns. The earlier deadline is designed to give the business time to file and provide the owners with a document called a Schedule K-1, which they need to file their personal returns. The second major deadline is April 15th. This is the date most people are familiar with. It is the filing deadline for sole proprietorships, who report their business income on a Schedule C as part of their personal Form 1040, and C corporations, which are taxed as separate entities and file Form 1120. It's also worth briefly mentioning extensions. If you are unable to file your business tax return by the deadline, your tax professional can file an extension on your behalf. This typically gives you an additional 6 months to get the paperwork filed. However, and this is a critical point, an extension gives you more time to file. It does not give you more time to pay the taxes you owe. You are still required to pay an estimate of your tax liability by the original deadline to avoid penalties and interest. To recap, the business tax year has a distinct rhythm. For quarterly estimated tax payments, a critical information reporting deadline on January 31st, and the main spring filing season with staggered deadlines in March and April. This calendar is your map. Your tax professional is your navigator. They will ensure you meet every single one of your specific deadlines. Beyond just meeting deadlines, a great tax expert helps you plan strategically. In our next chapter, Chapter 10, we will explore the concept of the year-end tax planning meeting, a crucial tool for legally and effectively minimizing your tax burden. Thank you for listening. Welcome back to How to Find a Reputable Tax Expert for Your U.S. Small Business. In our last chapter, we mapped out the tax calendar, focusing on the essential deadlines and compliance tasks that keep your business in good standing with the IRS. Compliance is about meeting your obligations. It is the foundation. But the real power of having a great tax professional on your team isn't just about filing on time. It's about being strategic. It's about making informed choices that legally and ethically optimize your financial position. The single most important event for this purpose is the year-end tax planning meeting. In this chapter, we will explore the purpose of this crucial meeting. We'll outline the key concepts and topics you can bring to the table to have a productive, forward-looking conversation with your expert. This is where your relationship transforms from reactive to proactive. A critical disclaimer before we proceed. This chapter will discuss common tax planning concepts for educational purposes only. These are topics intended to help you prepare for a conversation with your qualified tax professional. This is not tax advice. The strategies discussed are highly dependent on your specific business structure, income level, and overall financial situation. Whether any of these concepts are appropriate for your business is a determination that can only be made by your licensed expert who understands your unique circumstances. The core purpose of a year-end tax planning meeting, typically held in November or early December, is to review your financial performance for the year to date and identify opportunities to influence your final tax liability before the December 31st cutoff. Let's begin with the most fundamental principle of tax planning: the timing of income and expenses. For many small businesses, especially those on the cash basis of accounting, you have a degree of control over when income is officially received and when expenses are paid. A discussion with your expert can help you leverage this timing. One common topic is deferring income. The concept is simple: legally pushing income that you might otherwise receive in the current year into the next year. For example, you might discuss with your expert the strategy of sending invoices for work completed in late December with a due date in early January. This could potentially shift that taxable income into the next tax year. Your professional can advise you on whether this is a suitable and compliant strategy for your business model. The flip side of this coin is accelerating expenses. This involves intentionally making and paying for necessary business purchases before the end of the year, rather than waiting until the new year. You might talk to your expert about paying for things like an annual software subscription in December, stocking up on necessary office supplies, or paying for professional conference registrations in advance. Your expert is the key to understanding which prepaid expenses are legally deductible in the current year, and which are not. By reviewing your year-to-date profit and loss statement, your advisor can help you analyze if a combination of these timing strategies makes sense for you. Next, let's move on to strategic investments in your business and your future, and how they relate to your tax picture. These are key deduction opportunities. A major discussion point for any year-end meeting is the topic of capital expenditures, which means purchasing large assets like vehicles, machinery, or computer equipment. The tax code contains provisions that can allow for significant first-year deductions on these types of purchases. You might have heard of terms like Section 179 expensing or bonus depreciation. These are complex rules, but the strategic question to ask your expert is: if we are planning to buy a new piece of equipment soon, would it be more tax advantageous to purchase it before or after December 31st? Your expert can run the numbers and show you the potential tax impact of your timing. Another powerful topic to discuss is retirement plans for small business owners. This is one of the best ways to reduce your current business income while saving for your own future. You can ask your professional to explain the options available to you, such as a SEP IRA, a simple IRA, or a solo 401k. Each has different contribution limits, deadlines, and rules. Your expert can help you understand which type of plan might be the best fit for your business and personal financial goals, and how much you can contribute for the current tax year. Finally, a good year-end meeting looks at the big picture of your business, including salaries and business structure. If your business is an S-corporation, a critical year-end topic is your owner's salary. S-corp owners are required to pay themselves a reasonable compensation for the work they do. Your tax advisor plays a vital role in helping you determine what is considered reasonable and ensuring your salary is properly documented, which is crucial for compliance. This meeting is also a perfect opportunity to have a high-level conversation about your entity structure. Ask your expert, based on our current profitability and my goals for next year, is our current business structure still the most tax-efficient choice for us? As your business grows, the answer to that question can change.
Disclaimer: this video is for informational and educational purposes only and should not be considered professional legal, financial, or tax advice. I am not a certified public accountant, CPA, or a tax attorney. You should consult with a qualified professional for advice tailored to your individual situation. Tax laws are complex and subject to change. The creator of this video or the channel will not be held liable for any actions taken based on the information provided.
To summarize, your year-end tax planning meeting is your chance to be a strategist. By preparing to discuss the timing of income and expenses, major equipment purchases, retirement contributions, and your overall business structure, you empower your expert to give you their best advice. You should leave this meeting with a clear, actionable plan for the final weeks of the year. We've focused heavily on federal income tax so far, but that's only one piece of the puzzle. In Chapter 11, we will broaden our scope to discuss two other critical areas your expert can help you navigate: state and local taxes, and the ever-growing complexity of sales tax. Thank you for listening. Welcome back to How to Find a Reputable Tax Expert for Your U.S. Small Business. Throughout this series, our primary focus has been on the world of federal income tax, which is governed by the IRS. We've discussed finding an expert, working with them, and strategically planning for your federal obligations. But for nearly every small business in the United States, that is only one piece of a much larger, more complicated puzzle. Beneath the federal level lies a complex and varied web of state, local, and sales taxes. Navigating this landscape can be one of the most challenging aspects of compliance for a modern small business, especially one that operates online. In this chapter, we will provide a high-level overview of these other tax domains. Our goal is not to explain the specific rules, which would be impossible, but to raise your awareness of their complexity and reinforce the critical value of having a knowledgeable professional on your team. Critical disclaimer: the information in this chapter is for general educational purposes only. State, local, and sales tax laws are incredibly diverse, vary dramatically from one jurisdiction to the next, and are subject to frequent change. What is true for a business in Texas is completely different for a business in California. This chapter is designed to highlight the concepts you need to be aware of. You must rely on a qualified professional with specific expertise in your areas of operation for any advice or guidance. Let's begin with the broad category of state and local taxes. While the federal government levies an income tax, most states do as well. As of today, 43 states have either a corporate income tax or a gross receipts tax. This means your business might have to file a completely separate income tax return for each state in which it does business, each with its own set of rules, rates, and forms. But it doesn't stop with income tax. Depending on your location, you may be subject to a variety of other state and local taxes. These can include franchise taxes. Some states impose a franchise tax, which is essentially a tax for the privilege of existing and doing business in that state. Unlike an income tax, it can be based on your business's net worth or total assets, meaning you might owe this tax even in a year when you don't have a profit. Local taxes. It's not just states. Many cities, counties, and other municipalities impose their own business income taxes, payroll taxes, or other local levies. Business property taxes. If your business owns real estate, you are likely familiar with property taxes. But many jurisdictions also tax business personal property, which can include your machinery, equipment, computers, and even your inventory. The crucial question that determines your obligation to pay these taxes is the concept of nexus. Nexus is a legal term that, in simple terms, means having a sufficient business connection or presence in a state or city for that jurisdiction to have the right to tax you. Traditionally, nexus was created by having a physical presence, an office, a warehouse, an employee, or a salesperson in that state. However, as we will see, the definition of nexus has expanded dramatically, making this a minefield for modern businesses. This brings us to what is perhaps the most complex tax challenge for today's small business: the modern maze of sales tax. For decades, the rule for sales tax was relatively simple, based on the physical presence standard. If you had a store in a state, you collected and remitted sales tax to customers in that state. If you shipped a product to a customer in a state where you had no physical presence, you generally didn't have to collect their sales tax. That all changed in 2018 with a landmark Supreme Court decision, South Dakota versus Wayfair. This ruling fundamentally altered the landscape of sales tax in the United States. The court decided that states could require businesses to collect and remit sales tax, even if they had no physical presence there. This introduced a new standard called economic nexus. Economic nexus means that if your business sells more than a certain amount or conducts more than a certain number of transactions into a state, you are considered to have a significant enough economic connection to be required to comply with their sales tax laws. This has created an explosion of complexity for a few key reasons. First, every state has different rules. The economic nexus threshold in one state might be $100,000 in sales, while in another it might be $250,000. Some states also have a transaction threshold, like 200 separate sales. Second, what is considered taxable varies wildly. A digital product might be taxable in one state, but not another. Services might be taxable in some jurisdictions but not others. Third, the rates are not uniform. There are thousands of different sales tax jurisdictions when you combine state, county, city, and special district taxes. The sales tax rate for a customer in one zip code could be completely different from a customer just a few miles away. For an e-commerce business selling to customers across the country, manually tracking, collecting, and remitting the correct sales tax is nearly impossible. This is not a task for a spreadsheet. It requires sophisticated software and expert oversight. To summarize, the world of tax extends far beyond the IRS. The layers of state income and franchise taxes, combined with the immense complexity of post-Wayfair sales tax, present a significant compliance challenge. This is precisely where your tax expert proves their worth. A reputable professional will help you perform a nexus study to determine where you have tax obligations, ensure you are properly registered, and help you implement systems to stay compliant. They transform this overwhelming maze into a manageable process. So, what happens if, despite your best efforts, you receive a notice from one of these tax agencies? In Chapter 12, we will discuss the proper way to respond to tax notices and the critical role your expert plays in representing you. Thank you for listening. Welcome back to How to Find a Reputable Tax Expert for Your U.S. Small Business. In our last chapter, we explored the complex world beyond federal taxes, touching on the challenges of state, local, and sales tax compliance. That discussion highlighted just how many different government agencies a business owner must interact with. Sooner or later, it's very likely that an official-looking envelope from the IRS or a state tax agency will arrive in your mailbox. For any business owner, this can be a moment of immediate stress and anxiety. Your mind might race with questions and worst-case scenarios. The purpose of this chapter is to give you a clear, calm, and practical playbook for exactly what to do, and just as importantly, what not to do, if you receive a tax notice. Our goal is to replace that feeling of panic with a confident, procedural response. Critical disclaimer. This chapter provides general, procedural guidance for educational purposes only. It is not legal or tax advice for responding to any specific notice you may receive. Every notice is unique, and the proper response depends entirely on the specific facts and circumstances. You must rely on your qualified tax professional for guidance on your specific situation. Before we discuss what you should do, let's cover the golden rules of what not to do. Avoiding these common mistakes is the first step toward a successful resolution. Rule number 1. Do not ignore it. This is the most critical rule of all. Tax notices are time-sensitive and come with response deadlines. Ignoring a notice will not make it go away. In fact, it will almost certainly make the situation worse. An unanswered notice can quickly escalate, leading to additional penalties, mounting interest, and more aggressive collection actions like liens or levies. The problem will always be smaller and easier to solve on day 1 than it will be in 6 months. Rule number 2. Do not panic. The vast majority of tax notices are not about a full-blown audit or a criminal investigation. Many are simple, computer-generated letters flagging a potential issue. It could be a simple math error, a reported income figure that doesn't match a third-party form, or a request for more information about a specific deduction. Panicking can lead to hasty decisions and unnecessary stress. Remember, this is a normal part of doing business. Rule number 3. Do not immediately call the phone number on the letter. Your first instinct might be to call the agency to clear things up. This is usually a mistake. Calling without being fully prepared, without having all the necessary documents in front of you, and without a clear understanding of the issue can be unproductive at best. At worst, you could inadvertently say something that is confusing or incorrect. This is a conversation your trained professional should handle. Now that we know what to avoid, let's walk through a simple step-by-step action plan for the right way to respond. Step 1. Take a breath and read the notice calmly. Open the envelope and read the entire notice from beginning to end. Don't try to interpret the complex legal language or solve the problem yourself. Your only goal right now is to gather basic information. Look for these key items: the name of the tax agency, IRS, California Franchise Tax Board, etc. The notice number, often found in the top right corner. This number, like CP 2000 for the IRS, tells your expert exactly what kind of notice it is, the tax year in question, and most importantly, the deadline for your response. Step 2. Contact your tax professional immediately. This is the single most important action you can take. Send them an email or call their office and say, "I have received a notice from the agency for the tax year, and I am sending it to you." This is precisely why you hired them. They have the training and experience to handle this. They have seen thousands of these letters and understand the process inside and out. Step 3. Send them a clear copy of the entire notice. Do not just send them the first page. Scan every single page of the notice into one clear PDF document and send it to your professional, preferably through their secure online portal. A clear, complete copy is essential for them to make an accurate assessment. Step 4. Authorize them to represent you. In order to speak to the tax agency on your behalf, your expert needs your formal permission. They will likely ask you to sign a power of attorney form, such as IRS Form 2848 or a similar state-level form. This document officially authorizes them to receive information and act on your behalf in the matter. This is a standard and necessary step. Once you have completed these steps, your direct involvement is mostly finished. You can now focus on running your business, knowing that a qualified professional is handling the issue. So, what do they do next? First, they will analyze the notice to understand the exact issue and verify its accuracy. Then they will formulate a strategy for the response. This may involve gathering specific documents from you, such as bank statements or receipts, to support your position. Finally, and most importantly, they will handle all communication with the tax agency. They will write the response letters and make the phone calls, speaking the technical language of the tax world to advocate for the correct and most favorable outcome for you. To summarize, the process is simple. Don't panic, don't ignore it, and call your professional. A tax notice is a manageable event when you have an expert on your team. It is a problem to be solved, not a crisis to be feared. We have now covered many of the technical aspects of tax and compliance. But what about the day-to-day habits of a business owner? In Chapter 13, we will explore the key financial habits that complement the work of your tax expert and lead to long-term business health. Thank you for listening. Welcome back to How to Find a Reputable Tax Expert for Your U.S. Small Business. Over the course of this series, we have dedicated a great deal of time to the role of your tax professional, how to find them, what to ask them, and how they can guide you through the complexities of the tax code. But a successful financial outcome is a partnership, and your expert is only one half of that equation. The other half is you, the business owner. The most successful business owners don't just delegate their finances, they engage with them. They cultivate specific, disciplined habits that create a strong financial foundation, which in turn empowers their tax expert to be a far more effective and strategic partner. In this chapter, we will shift the spotlight onto you. We'll explore the key financial habits that separate the most successful entrepreneurs from the rest. These are the practices that complement the work of your expert and lead to long-term financial health and stability for your business. As we begin, a reminder. The habits discussed here are general business best practices for educational purposes. They are not specific financial advice. The right financial management strategy for your business should be developed in consultation with your qualified financial and tax professionals, tailored to your unique situation. Let's start with the habit that underpins everything else. Habit number 1. The non-negotiable act of clean and current bookkeeping. We've mentioned this before, but it's so important that it deserves to be framed as a core habit. Clean bookkeeping is not a chore to be frantically completed in the first few months of the new year. It is an ongoing discipline, like exercising or eating well. The most successful business owners set aside time every single week to manage their books. This means categorizing new transactions, reconciling bank and credit card accounts, and ensuring everything is up to date. Why is this so critical? Because your books are the dashboard of your business. When they are current, they give you a real-time, accurate view of your financial health. This allows you to make smart, data-driven decisions every day about your pricing, your spending, and your growth. For your tax expert, this consistent habit is a game changer. It means they can provide proactive advice based on current numbers, not just reactive analysis of year-old data. Once your books are in order, you can cultivate our second habit. Habit number 2, the CEO check-in, regularly reviewing your financial statements. It doesn't matter if you're a one-person operation or a team of 50. As the owner, you are the CEO. And a CEO must understand the company's financial performance. This means scheduling a regular, recurring date with your two most important financial reports. First is the monthly review of your profit and loss statement, or P&L. Your P&L tells the story of your business's performance over a period of time. Looking at it every month allows you to ask critical questions. Are my revenues trending up or down? Which of my product or service lines are most profitable? Are any of my expense categories, like marketing or supplies, growing faster than my revenue? Second is the quarterly review of your balance sheet. In simple terms, the balance sheet is a snapshot of your business's financial health on a single day. It shows what your business owns, its assets, and what it owes, its liabilities. Reviewing this report helps you answer crucial questions like, do we have healthy cash reserves in the bank? Is our debt level manageable? This habit of regular review does two things. First, it transforms you from a passenger into an active, engaged driver of your business's finances. Second, it allows you to have much smarter, more strategic conversations with your tax expert. You'll be able to ask better questions and better understand the advice you receive. This leads us to our third critical practice. Habit number 3, proactive and disciplined cash flow management. There is a famous saying in business: revenue is vanity, profit is sanity, but cash is king. A business can be profitable on paper, but still fail if it runs out of cash to pay its bills. A savvy business owner understands this and actively manages their cash flow. One of the most powerful habits in this regard is to systematically set aside money for taxes. A common and highly effective practice is to open a separate business savings account specifically for taxes. Then, every time your business gets paid, you develop the discipline to immediately transfer a certain percentage of that revenue into your tax savings account. What should that percentage be? That is a perfect strategic question for your tax professional. Based on your business structure and profitability, they can help you determine a reasonable percentage to set aside. By doing this consistently, you ensure that you are never caught off guard by a large tax bill. You've already saved for it. This simple habit removes one of the biggest sources of financial stress for business owners. To summarize, these foundational habits, consistent bookkeeping, regular review of your financial statements, and proactive cash flow management, create a virtuous cycle. They make your business financially stronger, they make you a more confident and informed leader, and they elevate your relationship with your tax expert from a simple compliance task to a true strategic partnership. Now that we've discussed habits for financial health, what about habits for financial security? In our next chapter, Chapter 14, we will discuss how to protect your sensitive financial data and how to spot and avoid common tax-related scams. Thank you for listening. Welcome back to How to Find a Reputable Tax Expert for Your U.S. Small Business. In our last chapter, we focused on the positive, internal habits that create a strong financial foundation for your business. Building a healthy business is a significant achievement, but in our increasingly digital world, it's just as important to know how to protect it. Small business owners are prime targets for criminals who want to steal sensitive financial data and commit fraud. Your vigilance is your best defense. In this chapter, we will cover two critical areas. First, the proactive digital security habits you can adopt to protect your information, and second, how to recognize and avoid the most common and dangerous tax-related scams. Disclaimer: please note, this chapter provides general information and best practices for security awareness. It is not a comprehensive cybersecurity guide. For a complete assessment of your business's digital security, you should consult with a dedicated IT security professional. Let's begin with proactive protection. The digital security habits that can build a virtual fortress around your financial life. Habit number 1. Use strong, unique passwords for everything. This is the absolute bedrock of online security. A simple, easily guessed password is like leaving your front door unlocked. A strong password should be long, at least 12 to 15 characters, and include a mix of uppercase and lowercase letters, numbers, and symbols. Most importantly, you must use a different password for every single online account. If you reuse the same password and one site gets breached, criminals will try that same password everywhere else. The best way to manage this is with a reputable password manager, a tool that creates and stores highly complex passwords for you. Habit number 2. Enable two-factor or multi-factor authentication. You've likely seen this abbreviated as 2FA or MFA. In simple terms, it means your password alone is not enough to get into an account. You also need a second piece of information, usually a temporary code sent to your phone or generated by an app. This is one of the single most effective ways to protect your accounts. Even if a criminal manages to steal your password, you should enable this feature on every sensitive account you have. Your business bank accounts, your accounting software, your payroll service, and your primary email account. Habit number 3. Be wary of public Wi-Fi. The free Wi-Fi at a coffee shop, airport, or hotel is an unsecured public network. It is relatively easy for skilled criminals on that same network to intercept the data you are sending and receiving. You should avoid accessing any sensitive financial information, like logging into your bank or processing payments, while on public Wi-Fi. It is much safer to use your phone's mobile hotspot or a virtual private network, known as a VPN, which encrypts your connection. Habit number 4. Share sensitive information securely. As a business owner, you will need to share sensitive documents with your tax professional, your bookkeeper, or your bank. Email is not a secure method for sending documents that contain social security numbers, bank account details, or other private data. This is why most modern tax professionals provide their clients with a secure online portal. These portals are encrypted and designed specifically for the safe exchange of confidential information. Always use these tools when they are offered. Now that we've covered proactive defense, let's learn to spot an attack. Let's explore the scammer's playbook and how to avoid common tax scams. The best way to defeat a scammer is to understand their tactics. Tactic number 1. Creating panic with threats and urgency. Scammers know that when people are scared, they don't think clearly. A very common scam involves an aggressive, threatening phone call from someone pretending to be from the IRS. They will use frightening language, threatening you with immediate arrest, a lawsuit, or the revocation of your business license if you don't pay them immediately. Here is the crucial fact you must remember. The IRS and legitimate state tax agencies will almost never initiate contact with you by phone, email, or text message to demand immediate payment. Their primary method of initial contact is always official correspondence sent through the physical mail. If you receive a threatening phone call, hang up. It is a scam. Tactic number 2. Demanding unconventional payment methods. This is a giant red flag. A scammer will insist that you must pay your supposed tax debt immediately using a specific and untraceable method. They will demand payment via a wire transfer, a prepaid debit card, or by asking you to buy hundreds or thousands of dollars in gift cards and read the numbers to them over the phone. Let's be perfectly clear. No legitimate tax agency will ever demand payment in these forms. You pay the U.S. Treasury or your state's official Department of Revenue, typically through their website, by mail, or with a standard bank payment. If anyone asks you to pay a tax bill with a gift card, it is 100% a scam. Tactic number 3. Phishing for your information. Phishing involves scammers sending emails or text messages that are designed to look official. They might claim there is a problem with your tax return, or even tempt you with a large, unexpected tax refund. The goal of these messages is to get you to click on a malicious link, which often leads to a fake website designed to steal your login credentials or other personal information. Look for the red flags. A generic greeting like "Dear Taxpayer," spelling and grammar mistakes, and email addresses that don't match the official government agency. The golden rule is simple. Never click on links in unsolicited emails or texts. If you think there might be a legitimate issue, go directly to the official IRS or state agency website by typing the address yourself. In short, your best defenses are a proactive approach to your digital security and a healthy dose of skepticism. If a communication feels urgent, threatening, or too good to be true, trust your instincts. It's almost certainly a scam. When in doubt, do not engage. Hang up, delete the message, and if you're concerned, contact your tax professional. We have covered a vast amount of ground in this series. In our final chapter, Chapter 15, we will bring everything together, recapping the key takeaways from our journey and providing a simple action plan to put it all into practice. Thank you for listening. Welcome back for the final time to how to find a reputable tax expert for your U.S. small business. Over the last 14 chapters, we have embarked on a comprehensive journey. We started with a simple but powerful question: why do you need a tax expert? And have systematically built a complete roadmap that takes you from that initial uncertainty to a confident and successful professional partnership. You've invested your time to learn this process, and that in itself is a significant step toward taking control of your business's financial future. The purpose of this final chapter is to bring everything together. We will briefly recap the key stages of our journey and, more importantly, distill it all into a simple, 4-step action plan you can use to move forward with clarity and purpose. Let's begin by looking back at the journey we've taken. We can organize everything we've learned into 3 main themes: the search, the partnership, and the strategy. First was the search. We established that a tax expert is not an expense, but a strategic investment in your business's health. We demystified the credentials, clarifying the different roles of CPAs, enrolled agents, and tax attorneys. We then gave you a practical map, showing you where to find qualified candidates through professional directories and trusted referrals. Finally, we armed you with the key questions to ask during the interview and a framework for evaluating the answers to make a confident, informed choice. Next, we explored the partnership. Once you made your choice, we discussed how to build a successful and productive relationship. You learned that being an organized and proactive client is the key to unlocking your expert's true value. We covered the importance of an annual review to ensure the partnership continues to meet your evolving needs. And we provided a professional, step-by-step guide for making a smooth transition if a change ever becomes necessary. And we gave you a calm, procedural playbook for handling the stress of a tax notice by immediately leveraging your expert's experience. Finally, we delved into the strategy. We moved beyond just finding an expert and explored how to use their guidance. We mapped out the key deadlines of the tax calendar. We highlighted the immense value of a strategic year-end tax planning meeting. We broadened your awareness to the complex world of state, local, and sales taxes. And we turned the focus back on you, covering the foundational financial habits and the crucial security practices that protect your business and make you a more effective leader. Knowledge is powerful, but only when it is put into action. Now let's translate this knowledge into momentum with your action plan. 4 simple steps to get started. This isn't about doing everything at once. It's about taking the next logical step. Step 1. Assess your true needs. Before you do anything else, take a moment to reflect. Think about your business right now and where you want it to be in a year. Ask yourself, is my most pressing need just to get my taxes filed accurately and on time? Or is my need more strategic? Do I need guidance on cash flow, business structure, and long-term planning? Answering this question will help you focus your search on the right type of professional from the very beginning. Step 2. Start your search list. Don't let this be an intimidating task. Your goal for this week is simply to create a list of 3 to 5 potential names. That's it. Take one concrete action from Chapter 3. Go to the National Association of Enrolled Agents website, or your state's Society of CPAs directory. Use their search tool to find professionals in your local area who specialize in small businesses. Write down their names and contact information. Step 3. Schedule just one consultation. You don't need to interview everyone on your list this week. The goal is to break the inertia and start a conversation. Pick one name from your list that seems promising and reach out to schedule a brief, introductory consultation. Remember the goal of this first call. You are simply gathering information to see if there is a potential fit. This single action will make the entire process feel real and achievable. Step 4. Commit to one good habit. While you are searching for the right partner, you can begin preparing to be a great one. Take inspiration from Chapter 13 and commit to one new financial habit, starting today. Perhaps it's blocking out 30 minutes on your calendar every Friday afternoon to update your bookkeeping. Or maybe it's opening a separate savings account for taxes. This small, consistent action builds the financial discipline that will make your future partnership incredibly successful. And that is your path forward. Assess, search, schedule, and commit. Thank you for joining us on this journey. We hope this series has demystified the process of finding a tax expert and has empowered you to take confident control of your business's financial management. To close, our final and most important reminder. This entire audio series has been for educational and informational purposes only. It is not, and was never intended to be, a substitute for professional financial, legal, or tax advice. The United States tax code is immensely complex and is unique to every individual and business. We strongly urge you to consult with a qualified, licensed professional who can provide guidance tailored specifically to you. We wish you the very best in building a successful, prosperous, and financially sound business.
Disclaimer. This video is for informational and educational purposes only and should not be considered professional legal, financial, or tax advice. I am not a certified public accountant, CPA, or a tax attorney. You should consult with a qualified professional for advice tailored to your individual situation. Tax laws are complex and subject to change. The creator of this video or the channel will not be held liable for any actions taken based on the information provided.